Good afternoon, everybody. My name is Kishore Mahbubani. I'm the Dean of the Lee Kuan Yew School of Public Policy, and it gives me great pleasure to welcome you to this public lecture. I think you all know that I can only count up to 3, and I can only make 3 points in my introduction before I turn over the floor to Sir Paul Tucker, and I'm very grateful that he's come all the way here to deliver the S.T. Lee lecture. So my first point will be about Dr. Lee Seng Tee, and to thank him once again for being such a generous supporter of our school. And as a result of his support, we've managed to get very distinguished people to come and deliver the S.T. Lee lecture. We've even had other central bank governors like Philip Hildebrand. We've had university presidents like Jack DeGoya from Georgetown, Lee Bollinger from Columbia, and last week we had Michael Spence from the University of Sydney, and we've also had Roderick McFarquhar from Harvard with us. And so I'm really delighted that Sir Paul Tucker is carrying on this tradition of keeping up this S.T. Lee lectures at our school. The second point I'm going to make is about the topic, and I'm actually very glad that Sir Paul Tucker had decided to address this very difficult topic of the international monetary system. I'm sure that many of us are confused. We're trying to figure out what exactly is happening in that universe, because we seem to be on some kind of a roller coaster ride in trying to figure out whether the system is stable or whether the system is going to fall apart. We go through all these scares every few years, and in that regard, I can tell you that I'm delighted that Paul has decided to address this very difficult topic. My only question, as I actually managed to browse through his slides, I began to ask myself, will I be able to understand his lecture? But he's promised me that he will deliver the lecture in a way that will, even layman like me can understand what he's trying to say. And finally, a quick word about our speaker. He's the former Deputy Governor for Financial Stability, and he was a member of the Monetary Policy Committee at the Bank of England. And he's currently a senior fellow at Harvard University in both the Musawa Ramani Center for Business and Government, which is run by Larry Summers at the Kennedy School, and he's also at the finance unit of the Harvard Business School. He's a graduate of Trinity College, Cambridge, and he joined the Bank of England soon after he obtained his degree in maths and philosophy. I guess you need to be good in both maths and philosophy if you're going to understand the financial universe. In the Bank of England, he's held a variety of key roles. I'll just mention a few, including being a member of the negotiating team for the Basel International Capital Convergence Agreement. He's been an advisor to the Hong Kong Government Security Review Committee and the Deputy Director for Financial Stability in 1999, before rising to become a member of the Monetary Policy Committee in 2002 and Deputy Governor for Financial Stability in 2009. He was also a member of the bank's Financial Policy Committee, Prudential Regulation Authority Board, and the Court of Directors. And you can see that he's been everywhere, done everything, and he basically knows where all the various knobs are of our international monetary system. As a member of the BOE Governors Executive Team, he served as the Governor's alternate in Basel, was a member of the G20 Financial Stability Board Steering Committee, where he chaired the group on resolving large and complex banks, and he was also a member of the Bank for International Settlements Committee on the Global Financial System. He joined Harvard in October 2003 and was knighted in 2014 in the New Year's Honours List for his services to central banking. In short, we are truly blessed that we have someone really distinguished to address us today, and really pleased to welcome now Paul to deliver the lecture.
Kishore, thank you very much. It's a real delight to be here. When your Deputy Prime Minister suggested to me, about 6 months ago probably, that I spend some time in Singapore, I was immensely keen to come, and I'm extremely grateful to you for inviting me. I'm spending the week here. It's great to spend a full week in Asia, rather than, as in my last few years in office, I would fly in for a day, go to a meeting in a room that could have been anywhere on planet Earth, and then fly out. Now I have time to spend a bit of time here and admire and learn from the remarkable growth in this part of the world. Singapore was founded and gained its independence in a completely different system for the world economy, the world monetary system. In fact, that system was on its last legs. The Bretton Woods system of fixed exchange rates, which was established at the end of the Second World War, finally collapsed in the early 1970s. And apart from those early years, the entire rise of Singapore as a fantastically successful economy and financial center has been in the post-Bretton Woods world. And the post-Bretton Woods world has been incredibly volatile. It has been characterized by growth, pretty well everywhere in the world, but by periodic crises, most notably in Latin America and Eastern Europe in the early 1980s, in Asia itself in the 1990s, and now in Europe and the United States. And because Europe and the United States remain the largest parts of the world economy, the cost of that has been spread across the world. And throughout the experience of these crises in the 1980s, but especially in the 1990s and more recently, there has been a call to reform not only the financial system, which turned out to be so frail, but actually somehow to reform the rules of the game in the international monetary system, this world of floating exchange rates and free flow of capital, which has brought benefits to many, but with more than hiccups occasionally. And this latest crisis was exactly the same. There was a call from the leaders for everything to be reformed. But the leaders did something very special. And I say this not just because there's a very distinguished team of trade negotiators sitting in the front row. The leaders did something really rather remarkable, and that bears mention because it's such a contrast from the 1930s, the last time the world economy completely fell apart. In the G20 summits of late 2008, and early 2009, they pledged to maintain free trade across the world. And this was truly a moment of leadership, and it could only have come from the leaders. It couldn't have come from central bank governors. It couldn't have come from finance ministers. It had to come from them. And for people like me who were involved in putting the pieces back together again, it was hugely easier that you realized that people sitting at the very top table were going to try to resist the temptation of reestablishing protectionism. They wanted two things reformed. They wanted the financial system reformed, which is hardly surprising because banks more or less everywhere in the Western world had fallen to pieces, and they wanted the international monetary system reformed. And the first of those has gone tolerably well. I won't talk about it in great detail, but the world financial system is being reformed in quite profound ways. The reforms of the international monetary system got stuck. And it got stuck because officials and politicians bumped into something that they should have known was there. There were two calls for reform. One was that in a world of current account imbalances, excess savings in Asia, excess borrowing in Europe and the United States of America, people wanted more symmetric adjustment. Well, history teaches us that actually those with the surpluses are never prepared to do much of the adjustment themselves. And this is not about Asia versus Europe and the United States of America in the 1940s and the 1950s. It was the United States that was not prepared to make the adjustment, but wanted Europe and the United Kingdom in particular to make the adjustment. And I suspect that if we trawled the history books for the last 1,000 years, we would find that it's the same. The savers never feel the pressure to adjust. It is always the debtors. And there is actually some moral validity in that. So that part of the reform program ran into the buffers. The other part of the international monetary system reform program was that the IMF should be strengthened, given more resources, and that as a quid pro quo for that, and as a recognition of the changing balance of power across the world, that the economies of Asia and Latin America should have a greater say, a greater quota at the top table at the IMF. And that too has stalled. I'm choosing my words carefully. I'm going to say stalled. It has stalled in the US Congress. Maybe it will make a comeback over the coming weeks and months. And if one took that at face value, then one would conclude that the reforms of the international financial system of banks and securities dealers have gone tolerably well, and the reforms of the international monetary system have yet again got nowhere, leaving with us the fragilities that have characterized the post-war world. And I'm not that pessimistic. In fact, I think that things are happening which can, not will, can make the international monetary system safer. And the headings I'm going to use to explain this are completely different from the headings that are typically used when the international monetary system is discussed. So on the left-hand column are the standard list of headings that people use when they are discussing reform in the international monetary system. Exchange rates, global liquidity, reserve currencies, will the euro and yuan rise alongside the dollar, the special drawing rights of the IMF, and then IMF governance. And I'm not going to talk about any of those whatsoever because that's not going so well, but I don't think all hope is lost. My list of headings is going to sound more technical, but I'm going to make it not very technical as I go along. The risk channel of monetary policy. You'll recognize that when I talk about it. National balance sheet monitoring and management. Then what will turn out to be a new buzzword, which has its dangers as well as its advantages, macroprudential policy. And then planning for controlled spillovers, controlled contagion from the failure of banks, which sounds like a contradiction in terms, but can be made a reality. And finally, lender of last resort, cooperation. So this is the point at which I have to meet Kishore's test of not getting, of not speaking to a room of economists. So what central banks do is they move interest rates around in order to try to stabilize the economy. And an abiding belief of the economics profession is that when, say, the Federal Reserve reduces interest rates by 1%, that will change interest rates for, say, 1 year, 2 years, 3 years, but it will have very little impact on interest rates or bonds with a maturity of 10 years or 20 years. The idea is that monetary policy can affect the near-term path of the economy, but actually it isn't going to affect anything very much in the very long term. And it turns out that that's not quite true. It turns out that if the United States, or the euro area for that matter, or in the future China, or even Britain, reduces its interest rates by, say, a percentage point, that will actually have an effect of some kind on long-term interest rates. And this has been documented by one of the current governors of the Federal Reserve Board, Jeremy Stein, a colleague of mine at Harvard and a friend. Now, the significance of this is as follows. It means that what's going on is that when a central bank cuts its interest rates, what investors do is move along the yield curve, move into longer maturities in order to try to maintain the yield that they are getting from longer term. They buy longer term securities to compensate for the low yield from short maturity instruments. And this pushes down the yield on longer term instruments. Now, that doesn't sound very exciting until I combine it with this. Many of you will have heard of the carry trade. What's the carry trade? You borrow a currency with very low interest rates, 10 years ago yen or Swiss francs, over the past 5 years dollars, and you invest in a currency with higher interest rates. And you make the spread. You pay a low interest rate, you earn a higher interest rate. And 20 years ago, people would have said, you can't make much money out of this systematically. Yes, you're earning an interest rate spread, but the currency is going to adjust to more or less cancel out the spread that you're earning. And that's indeed what all the textbooks would have been teaching for the last 30 or 40 or 50 years, except that it turns out you can make systematic money by doing the kind of transaction I just described. So the green line is the cumulative return you would earn by holding treasury bills from, say, the mid-1970s. The blue line that's quite jagged is the return you would get from holding US equities. The black line, you can ignore the red line, the black line is the return you would get from holding a portfolio of exactly the transactions I was describing. Borrow in low interest rate currencies, invest in high interest rate currencies. Turns out you can make quite a lot of money out of this. You can make systematic returns out of this. So why do these two things matter? They matter because what happens when a big country reduces its interest rate is that investors will search for yield. And they will search for it, and what this shows is that they will search for that yield anywhere on the planet. And because capital can flow anywhere, the returns could be anywhere. And what happens when that money pours into a small market offering enhanced returns? Well, it will push up the exchange rate, it will push up local asset values, it will push down the cost of credit locally, at which point you should be thinking, hold on, isn't the local central bank kind of meant to be controlling the cost of credit? Well, yeah, maybe, except this wave of money coming from somewhere, everywhere else in the world will be affecting the cost of credit. So the cost of credit is being pushed down. So maybe mortgage terms are becoming easier. So maybe houses are becoming more attractive to buy. So house prices are rising. So people feel richer, so they go spending. And so maybe there's a local boom. And now, the economy with the low interest rates decides that its interest rates aren't going to be so low anymore. And all the money flushes out. And credit conditions tighten, asset prices fall, spending gets reined in, and there's a nasty adjustment. And this should be recognizable. And it isn't just to do with the taper going on at the moment. This would have been recognizable in the 1990s and in degree in the 1980s. Let me pause there for a second. If somebody had been talking about the international monetary system 20 years ago, they'd have said, well, the reason we want free capital flows across the world, the reason why we have floating exchange rates and free capital flows is because plainly capital needs to flow to finance current account deficits. The countries with current account deficits need to borrow from the countries with current account surpluses, and the capital has to move from one place to another in order to deliver that. Look at the growth. This is the growth not of net capital flows financing current account deficits. This is the growth in gross capital flows, the stock positions. Look how it's increased over the past 30 or 40 years. And now look at actually the pattern of flows behind it. It is quite remarkable. The dark band of color at the middle, the blue above zero and the reddy browny color below zero, these are capital flows around the world that finance current account deficits. So over the last 10 years, you could think about China financing the US and British current account deficits. These capital flows are quite small in the scheme of things. Look at the gross capital flows. The capital flows that are chasing yield, or not just chasing yield, are investing in productive opportunities, in portfolios of equities, or directly in new investment opportunities, or just hot money. And look at how it builds up in the middle of the last decade, and then collapses very sharply in 2008 and 2009. And this is the money that moves in and out of economies and is the dark side, if you like, to the wonderful freedoms that the world economy enjoys through the rights to employ capital almost anywhere in the world. And then think back to the 1990s in this part of the world. Put Europe and the United States out of our minds for a moment and just think about what went wrong here. Well, capital can flee from a country because of a problem in the country itself. And that's what happened in some parts of Asia in the late 1990s. Thailand had borrowed, its government had borrowed too much short-term in foreign currencies, mainly in dollars, but in other foreign currencies as well. It didn't have the dollar income to support its short-term debts. In Korea, it was the banks. In Indonesia, interestingly, it was regular companies. It was non-financial businesses. All of them borrowing short-term, all of them in foreign currency from the international markets, all of them relying, as it turned out, on hot money, and the hot money fled. So those are examples of the hot money realizing that the countries themselves have got vulnerabilities and the hot money flees. But it can flee for other reasons too. So this part of the world took a very bad jolt, not only in 2008, 2009, but again in 2010, 2011, when the euro area was reaching perhaps the worst point of its crisis, and euro area banks cut back very sharply on the provision of trade credit in Southeast Asia, and disrupted, and there was a disruption, a temporary disruption to trade in this part of the world. And they didn't flee this part of the world because there were problems in this part of the world. They took money back home because it was needed at home. But actually, there needn't be a crisis anywhere for the hot money to move on. The hot money can move on just because it seems that there's a better opportunity next door, all next door but one. And so we have vulnerabilities. We have vulnerabilities due to the pattern of capital flows, and in particular, when there are short-term capital flows that can be withdrawn at no notice whatsoever. And I've made it sound as though all of the spillovers are from big countries to somewhat smaller countries and never back, or from big countries to big countries and never back. But actually, it's not like that. So now put Asia on one side and think about America and Europe over the past few years. Well, US investment funds had invested short-term in European banks, and the money fled when the European banks, or the euro area economy as a whole, looked as though it may be heading for crisis. And this made the euro area crisis worse. And by making the euro area crisis worse, it actually threatened to boomerang back on the United States, which was why the then Secretary of the Treasury, and indeed the President himself, was very focused on the euro area. It was not only that the euro area is a very large part of the world economy, it was also that as US money was taken out, it threatened to exacerbate a situation to the detriment of the United States. This is the Boomerang Effect. And at the moment, one might think that we live in a world where if hot money from a policy measure in country A spills over to country B, it's only going to come back to A if B is a very big economy indeed. And I'm not sure that's true. I think a lot of medium-sized economies put together count as a big economy. And as the emerging market economies of Asia and Latin America become collectively bigger, as surely they will and is something we should celebrate, then so the United States and Europe, including Britain, will have to be more attentive to spillovers from our policies to Latin America and Asia before they spill over back to us. And the lesson of all of this is that just as we have household balance sheets over which we should take care, and just as banks and ordinary businesses have balance sheets over which they should take care, so nations have balance sheets over which they should take care. And in fact, these national balance sheets are intertwined. And if anything needs to be done in terms of analysis in future that wasn't done in the past, it is the analysis of national balance sheets. And it is a sheer tragedy to have to say that, because that was exactly one of the key lessons of the Asian crisis of the late 90s. The Asian crisis delivered three big lessons. One was the virtues of floating exchange rates. Those lessons for most economies still stack up. Another one was the virtues of having fairly deep domestic capital markets. That lesson certainly stacks up and is something which Singapore most certainly has. And the third lesson was analyze national balance sheets. And somehow that got lost. And it turned out that the national balance sheets that needed most analysis were the United States, the United Kingdom, and the Euro area. So having preached this to Asia and Latin America in the 1990s, it turns out that the Western world didn't take its own medicine. And that has been a tragedy, not just for the Western world, but for the rest of the world as well. So that's the problem. Peculiarly, and ironically in a way, part of the solution became apparent very quickly, but not at all when thinking about the international monetary system or about whole economies. Instead, in the other part of the reform program I mentioned, in thinking about the financial system. So you think about, I'm not going to get at all into any of the details, you think about what regulation of the financial system involves. Somebody, my successors, people like me in the past, they write down rules for the regulation of banks and the regulation of securities dealers and the regulation of the new flavor of the month, central counterparties. And they have a public debate about whether these rules are adequate, and then they move on. But they leave behind a set of static rules. One of the big insights, an overdue insight, is no set of static rules is going to be good enough for all situations. Now there's a political economy problem, which I won't address, buried in the middle of what I'm about to say. But the prescription has become, wherever we set the regulations for banks or securities dealers or central counterparties, a capital ratio of 10% or 15%, a leverage ratio of 3%. Eventually there will be a credit boom of some kind, or there'll be an inflow of capital of some kind, where we need to tweak the parameters, where it turns out that 10% is not quite enough, where in order either to quell the boom and to protect ourselves against the bust, it needs to be 11%, or a little bit above, perhaps more than that, above where the standard regulatory requirement is calibrated. And this is now mainstream thought in financial regulation. This is called cyclical macroprudential policy, that just as we have cyclical monetary policy, we will have cyclical macroprudential policy, where the requirements on the banking system and other parts of the financial system will be varied when there is a boom of some kind. And there is a great lesson from this in terms of managing the risks facing a whole economy. So I call this whole economy macroprudential policy. So faced with a massive inflow of short-term money, why should one just sit there and do nothing about it? Which isn't to say that we should ban it. I'll come back to that. There are hazards in saying we should ban it. But we are entitled to say, whether it be Singapore or the United Kingdom or Thailand or anywhere on the planet, the United States could face this at some point. We are entitled to say, well, these short-term capital flows into our banking system or into our corporate sector, they need to be held liquid. Because just as they've come in quickly, they could go out quickly. And if they're withdrawn quickly, we will need liquid assets to repay the money. which is quite different from taking in the short-term money and investing it in illiquid projects. Now, if I go back to where I began, in terms of the leaders saying we aren't going to have protectionist policies, why don't we want protectionist policies? Because they're beggar thy neighbor policies. If I try to control the flows of capital into my economy so as to influence my exchange rate or terms of trade, to push the exchange rate below where it should be in a warranted sense, basically I'm trying to steal from my neighbor. What I've just described is almost the opposite of that. By laying down some requirements on how short-term capital should be employed in liquid form, what I am doing is ensuring that my economy is less likely to implode. And if I implode, my neighbor will be worse off. By avoiding my own implosion, I make my neighbor better off in bad states of the world. This is the opposite of a beggar thy neighbor policy. And many of you are sitting there thinking, yeah, but how can we tell the difference? There is a hazard here. It's hard to believe that an ugly term like macroprudential could be fashionable, but believe me, it is. If you're a regulator or a finance minister or a central banker and you say, I am doing X and I'm doing it for macroprudential reasons, well, the spirit of the times is that people say, well, that sounds absolutely fabulous. What a tremendous thing to do. And that means, of course, that almost anything could be dressed up in macroprudential form. And I've drawn a stark contrast between beggar thy neighbor policies and the opposite of beggar thy neighbor policies. And there is a real risk that countries will do things to prevent hot money flowing into their economy, and they won't be trying to deal with a balance sheet vulnerability. Instead, they will be trying to make their economy more competitive relative to their neighbors. And that would be a bad thing. It'd be a bad thing both because it makes one's neighbors worse off, and actually because it makes oneself worse off, because it's merely a way of dodging fundamental reforms. Singapore has never dodged making fundamental reforms, if I may say so. And I think the UK hasn't really over the last 30 or 40 years, but it can be very tempting in these circumstances. And if one looks at economies over the last few years, it's possible that a few have succumbed to this temptation. So there is a need to tell the difference between macroprudential policy and macroeconomic policies that are trying to improve an economy's competitiveness. And it's the job of the IMF to police that distinction. But provided they can do so, I think what I've described amounts to the following: that we now have a set of tools, if countries are prepared to use them, that can guard against some of the worst excesses of the international monetary system, the worst hazards that flow from capital not just bringing healthy investment, but also hot money that is here one day and gone the next. And if that's right, that even though we haven't got fundamental reform in the international monetary system, that may be because we don't even need it, that a world of floating exchange rates and freely flowing capital is the best world in which to live, provided we can ameliorate some of its worst symptoms, which is the problem of hot money. If that's right, crises will be less frequent, and that would be a good thing. But it would be absolutely crazy to rely on that. There will always be crises, and I'm afraid crises will always bring with them insolvent banks. And so the other thing that it's worth saying is that there have probably been 2 steps forward in dealing with banking crises as well, of completely different kinds. One is to do with, well, what happens when an international bank goes bust? Do we simply get the chaos that occurred after the failure of Lehman Brothers, which was particularly particularly acute in Europe and fairly acute here? And secondly, what happens when a country's banks have run out of a foreign currency, a currency that that country can't itself print? But before going on to that, let me say something about banking structure. And in this, I think I will echo some of the words of your Deputy Prime Minister 18 months or so ago. There is a great debate around the world about what should be done with the structure of banking. Volcker rules in America, Vickers in the United Kingdom, Liikanen in Europe, each of which has its merits. But there's a bigger thing, which I think has two parts. First of all, I think an economy can make a pretty good case for requiring that significant retail banks be subsidiaries rather than branches, that they actually have legal identity in the economy where they are significant. I'm not talking about small retail operations. I'm talking about really big banks serving the public and serving small and medium-sized businesses. I think this is much less important for the big wholesale international businesses. They are both run as one, and when they fail, the cost is more in terms of tax and employment rather than a collapse of the indigenous credit system. But with that behind me, let me make a very simple point about how to get something like controlled contagion when a big international bank goes bust, rather than chaotic contagion. So imagine a banking group that has a holding company, and it has three subsidiaries. Subsidiary 1 is domestic, it's in its own country, and subsidiary 2 and subsidiary 3 are in foreign countries. And the holding company has invested equity in each of its subsidiaries, and it has also invested a form of debt, deeply subordinated debt, so that after the equity, the subordinated debt will take the losses. And one of the foreign subsidiaries goes bust. Its equity is exhausted. Should the local authorities, the authorities here in Singapore, or if it was a London subsidiary, the authorities in London, put that subsidiary into liquidation, or should they hand the problem over to the parent company and country? Well, how can they do that? The equity is exhausted, the holding company can walk away. Well, if there's a layer of debt as well, and if that layer of debt is the next source of loss absorbency, this is a way of ensuring that all of the losses in the subsidiary flow up to the parent company. So what would happen? Imagine the foreign subsidiary there are 10 units of equity in the foreign subsidiary and 10 units of debt. And the losses are 12. So the equity is wiped. Of the debt, 2 will be written off. 8 will be converted into equity. All the losses have been transferred up to the holding company, and the foreign subsidiary now has equity of 8. The local authorities probably want that bank to shrink a bit, probably give it a year or so to do so, but they don't need to put it into liquidation. The holding company might now have some problems because it has taken all of the losses in the foreign subsidiary. But the holding company has also issued equity and debt, bonded debt. And if the holding company's equity is wiped out, then the bonds get transferred, get converted into equity. And so what's happened overall is at the top of the group, the ownership has flipped from the equity holders to the bondholders, the holding company bondholders, and further down, the holding company has lost its initial equity in the foreign subsidiary, but its subordinated debt has been transferred, converted into equity. And believe it or not, what I've just described is a plan. It's not a figment of my imagination. It is exactly what the G20 are working on. And the G20 summit last year gave the Financial Stability Board a year to come up with the details of making this plan work, and they will do it. I think it's immensely important for Singapore. It's immensely important for my country as well, the United Kingdom, because in both cases, we are essentially running entrepot financial centers with lots of foreign banks as well as indigenous banks. And this isn't only true of our countries, it's true of, in a different way, it's true for Mexico, and it's true for Poland, and it's true for New Zealand, all of whose banks are foreign-owned, or pretty well all of whose banks are foreign-owned. And unless there is a solution to this problem, international banking is deeply threatened. There is no doubt about that. And the only way of putting Humpty Dumpty back together again is to move from chaotic contagion to control contagion, which is that if you open a bank in a foreign country, then you need to elect to stand behind it. And I've just described, perhaps in too technical terms, a way of making that happen. So finally, what happens when you run out of money? Not you, Singapore, but a bank. But you haven't run out of your own money. Money you can print, pounds in the UK, euros in Frankfurt, dollars in New York, Singapore dollars here, but you've run out of somebody else's currency, which is far trickier actually, because you can't create that currency yourself. Exactly 40 years ago, we're just a few months short of the 40th anniversary of one of the most significant banking crises of the post-Second World War era. A bank called Herstatt, a German bank, failed in 1974. It didn't have enough dollars. It more or less defaulted on foreign exchange obligations, and chaos ensued. And the central bank governors of the day, meeting as they always do in Basel, concluded a division of labor amongst themselves for who should provide liquidity in those circumstances. And they had a network for doing it. It was a legacy of the gold standard era, where the Federal Reserve would lend dollars to other central banks. The Bank of England would lend sterling to other central banks. And for a variety of reasons, that network of swaps lapsed about 20 years ago. And it was revived, surprise, surprise, in 2007, 2008, because in particular the European banks, including to some extent in the UK, were short of dollars. They had bought dollar assets, illiquid dollar assets, and borrowed short-term in dollars. So exactly the problems that I was describing Korea as having 15 years ago. And they got the dollars from the Federal Reserve. And in exchange for the dollars, they provided euros. So who did? Did the banks in Europe borrow dollars directly from the Federal Reserve? Well, not quite. The ECB borrowed from the Federal Reserve. It gave the Federal Reserve euros as collateral, which the Federal Reserve placed on deposit with European central banks. The European Central Bank chose which banks in Europe to lend dollars to, and they, the European central banks, took the risk. The Federal Reserve did not take the risk. And here, in Asia, you created the Chiang Mai Initiative, which is a network of agreements amongst central banks, including the Monetary Authority of Singapore, to lend each other dollars. And this is, I think, an epoch-restoring moment, something that was necessary in today's monetary system, had been allowed to lapse and was recreated in a panic. And I think each country, and you are a member of the Chiang Mai Initiative, so you don't face this problem, but there will be countries that aren't a member of the Chiang Mai Initiative and can't agree a swap line with the Federal Reserve or the Bank of England or the ECB. And those countries need to be far more careful about allowing their banks to have liquidity mismatches in a currency that they can't create. Either you have to have foreign exchange reserves so that you are sitting on a pile of the currency yourself, or you have to be able to borrow the currency from the issuing central bank. This is such an obvious point about the international monetary system, that it is both peculiar that it was forgotten for a while and a great relief that it was recreated. Now let me start to conclude. So where does this leave the international monetary system? Well, it effectively says we're not going to do root and branch reform. We're not going to move away from floating exchange rates. We're not going to reintroduce systematic capital controls. We hope, going to reform the governance and resources of the IMF, Congress willing, but let's see. But what we are going to do is various things that will make the worst excesses of the current international monetary system architecture less prevalent, and where crisis does occur, give us more tools for handling them. And this has implications for the International Monetary Fund, which is the key steward of the international monetary system. First of all, they should heed the lessons of not only the Asian crisis, but now also especially the euro area crisis, which is look at national balance sheets, analyze them in the way that you would analyze a firm's or a household's balance sheet in some degree. When they are vulnerable, point that out to the country. And secondly, as far as crisis management is concerned, evaluate whether there are binding agreements between the home countries of banks and other financial institutions and host countries of financial institutions. Where there are, all well and good. When there aren't, well, the host country is going to need bigger fiscal resources than otherwise. If you can't turn to a home authority to borrow dollars or renminbi in the future or euros, then you're going to have more resources yourself. If you haven't got a resolution agreement with the home authority, well, then you may find yourself bailing out a foreign bank. I don't mean you, Singapore, I mean any country. And then the country needs more fiscal resources. And this seems a better place to be. It seems that actually, notwithstanding all the difficulties of reforming the international monetary system, that somehow some lessons have been learned, that some of the lessons for regulating banks can be turned around 15 or 30 degrees and applied to countries. So from this, I think we can, with sufficient determination, keep the benefits of the international monetary system, which, as well as being good for prosperity, I think has been good for freedom, and temper some of its excesses that we've lived with for far too long. Thank you.
I'm delighted to say that I was able to follow most of your lecture. And I want to thank you also for referring to two very distinguished members of the governing board of the Lee Kuan Yew School of Public Policy, who are here in the front row: Susan Schwab, the former United States Trade Representative, and Sheikh Alubna, Minister from the UAE government. And I'm sure they'll have some difficult questions to pose to you too. But I'm going to ask you, hopefully not too difficult a question, but a delicate question. In your scheme of things, you seem to suggest that the IMF has a critical role to play in all these things. But as you know, I'm not giving a big secret away, the trust in IMF in Asia went down very sharply after the 1997 Asian financial crisis. And then I think, to be honest, it actually went down again after the Euro crisis, because they said, excuse me, why is it you're being so nice to Greece when you basically shafted Indonesia and Thailand? So that basically led to the questioning about how much can you trust the IMF as a policeman in the global order. And now when the efforts are being made to reform the IMF and everybody agreed on the repackage of reforms, the US Congress suddenly killed it. So what do we do in a world where the role of the policeman becomes more important, but our trust in the policeman has gone down?
Well, these are good points. The truth is that in public life, you're always re-earning trust. So the IMF has probably got some trust to make good in this part of the world. But even if that wasn't the case, it would be having to re-legitimize itself all the time. I think the greatest tragedy over the last 15 years is that the IMF didn't take the lessons learned from the Asian crisis and apply them in the Western world.
In what way did they fail to apply it to the Western world?
Because they didn't say to the Euro area, to the United Kingdom, and in a slightly different way to the United States, you're too reliant on short-term foreign capital. It could all flee, which is what happened from Thailand, Korea, and Indonesia, and is what happened from the Euro area as well. In the United States and the United Kingdom, you've allowed property booms to develop, and eventually the bubble will burst. And I think people had just, not just the IMF, national authorities had assumed that somehow the markets would always sort this out. And the good that can come out of this is that everybody's learned that there isn't such a big distinction between the Asian economies and the Latin American economies and the European and the Asian economies, that the laws of economics and the laws of finance apply everywhere, and we are all in it together because we are all inextricably joined up. And the stronger voice that Asia and Latin America want at the top table of the IMF and elsewhere, it's fully supported in all the capitals because it's understood that not only are you now a big part of the world economy, but also that our problems afflicted you and damaged your economies, so that you need a bigger seat, and I think the Western world wants you to have a bigger seat there.
Okay, I'm now going to throw the floor open to, yes, Sheikh Al-Lubna, please. Would you mind going to the mic? You're going to videotape this.
One more point related to the IMF and sovereign wealth fund. I went lobbying everywhere because we were attacked. Norway was attacked. So many sovereign wealth funds were under attack due to governance and transparency. And lo and behold, 2 years later, you've got European crises, and IMF and every country gets back to the countries that they've accused of transparency, asking for money. So where is the consistency? I mean, Kishore, you talked about the difference of early on looking at Asian countries with crises and then looking at Europe. But where is the consistency in the way that a world institute like that should be the policing, really hammering and being very critical on the sovereign wealth fund, whereby a lot of the markets actually went bankrupt because of the private money and not the government.
Well, the two aren't completely mutually exclusive. I mean, if one looks ahead 20, 30 years, perhaps even over the next decade, it seems to me quite likely that sovereign wealth funds everywhere will become somewhat more transparent and will probably want to become more transparent, partly because they are, and not just from your part of the world or this part of the world. In Europe, the Norwegian fund is fantastically important. It can be a European phenomenon as well. These are great forces in world capital markets and in the world economy. And my guess is that it's in their interest slowly to become more transparent in the way that my old world, monetary policy, when I started out in 1980, it was deeply opaque. And if anything, the mystique of central banking was seen as a positive virtue. And that just could not be sustained. And it wasn't just democratic legitimacy that drove transparency in monetary policy. Monetary policy is more effective for being transparent. But I completely agree. I mean, that I don't think that the sovereign wealth funds brought about the world crisis in any way at all. Bad policies in the Western world brought this crisis about. I wouldn't even say, I'd rank that ahead of the private sector. Of course the private sector was excessive in its risk-taking, but the state chooses where to put the box. And we know that the private sector will take things right up to the edge of the box and beyond. And so we had better put the box in the right place, and we had better be prepared to move it from time to time. Which is another way of saying that the idea of writing down a static set of rules and, well, we can go off and do something else and take our eye off that is for the birds. Finance is the great shape-shifting industry of the world. If you take your eye off it for 1 second, rather than being a force for good, which it can become a force for destruction.
Can I just quickly follow up on that? One of the things that the sovereign wealth funds were unhappy about in that exercise is that they felt it was being driven by the United States Treasury, which wanted to go after the sovereign wealth funds, but was giving the hedge funds a free ride when they had the same kinds of issues as the sovereign wealth funds, and they were not transparent, they were not open, and they could check the markets as much as anybody else could, and still there's a reluctance to go after the hedge funds. What do you do about that?
There's a continuing debate about the extent to which non-bank financial institutions or non-bank-like financial institutions can wreak real damage in the financial system. And there are strong voices that are concerned about this. So Chancellor Merkel of Germany is probably the most prominent leader to ensure that this is on the agenda, and precisely because she wants it there, it isn't going to go away.
Okay, next question, please. Yeah. Again, identify yourself, if you don't mind. Yeah.
Absolutely.
Hi, Andrew Wong, Co-Chief Investment Officer at Fortress Investment Group, one of those non-bank financial institutions.
One of the dangerous guys.
You've spoken compellingly about how some of the reform of the financial system may help sort of unwittingly improve some of the performance of the monetary system.
Yeah.
At the same time, we seem to be observing increased levels of distress in a number of emerging markets, from Argentina to Turkey to Russia and so on. And last year, you mentioned the central role of the IMF. Famously, Christine Lagarde spoke up at Jackson Hole and said that there's a lot of massive inflows to the carry trade that you mentioned that have come into emerging markets. I think a number was $500 billion or thereabouts of excess flows over the past several years. And we all know the exit door is probably not as large as it might be, as the entry door might be. How should we think about monetary coordination amongst large central banks, given a reasonably sort of blunt and abrupt reaction that apparently she got at this meeting? Is there any hope that there can be such a thing as monetary coordination for the very largest leading central banks?
I think that in a strong sense, we're unlikely to get coordination because we have a world of floating exchange rates rather than fixed exchange rates. I mean, that is the biggest monetary decision the world takes together is, shall we have floating exchange rates or fixed exchange rates? And I think everything that we learned in the Asian crisis has been validated in the latest crisis, which is that a floating exchange rate helps a country adjust. I don't think there's any desire to move away from that. And as soon as you have that world, well, then monetary policy is going to be largely set according to domestic needs, the outlook for output and inflation domestically. But with the caveat that if there's a big spillover abroad, it's likely to come back your way. I think that's I think the big change over recent years as the emerging market economies have grown.
If that is the case, as you suggest, that it's unlikely that we'll have sort of tighter global monetary policy coordination, does that mean we should continue to expect countries to self-insure, which obviously is part of the initial imbalance?
I think they can self-insure in two ways. So a country can self-insure. So what this means is if you've got lots of external short-term foreign currency liabilities, the country can grow its foreign exchange reserves. Or it can make short-term capital go into liquid instruments locally. And since the Asian crisis, basically people have chosen to self-insure by having higher foreign exchange reserves, which actually is not a bad decision for each individual country, But in aggregate, it raised the world saving rate, pushed down the world rate of interest, pushed up asset prices, which is one of the things that fueled the credit boom in the West. What I've been describing is about another set of choices which have always been there, which is rather than accumulate more foreign exchange reserves, I will make the inflow of capital go into some liquid instrument in the private sector locally. And then, in terms of the burden of your question about coordination, you could imagine the big countries saying, I'm reducing interest rates because I need to stimulate my economy. That's in everyone's interests. I'm the largest or second largest economy in the world. But there is likely to be hot money flowing into other places. Why don't you ensure that hot money into the banking system goes into central bank balances or other liquid instruments locally? In other words, there's a richer menu than just building up foreign exchange reserves, and other countries have an interest in that. And so I think the answer to coordination is not that there would be coordination on the setting of monetary policy itself, but rather that there would be a richer collective dialogue about how to ensure that hot money was invested in liquid form.
Thanks.
Please, over there.
Yes, Milan Zavadil, consultant and former IMF. Thanks very much. It was a very...
You're very brave to admit it. Huh?
Yeah.
I was there on Friday, they're my friends.
There will be caveats. Thanks very much. That was very interesting and pragmatic. Now, there was a lot of criticism of the fund, and I think some of it rightly so. Now, but we still expect the IMF, to spot the vulnerabilities, to tell between the good and the bad capital inflows, whether countries should introduce macroprudential measures. Now, I'm not sure the current structure at the IMF can really do that. And, well, it can do it for small countries, because then it's quite easy to make a very rigorous analysis. For big countries, much more difficult. Having sat at the board,
Why more difficult?
Much more difficult because at the board, it's not that these issues are like the problems in the United States right before 2007, 2008. It's not that they're not discussed, but you're discussing them at the board where the US is the biggest shareholder, and it's quite risky for the staff. So, and ultimately, when it comes, when you have a big discussion, the report will always be toned down, and everything for bigger countries will tend to be smoothed over. So what I think is needed is a deeper reform of governance than what is on the table now. What is on the table now is just redistributing the votes. What I think needs to be done is something where you can have more objective analysis without the domination from the board. And I think actually Mervyn King came up with something like that. So what do you think of that? That we need a deeper...
I think that something spontaneous will happen in any case. I mean, I recognize in outline what you describe. I remember I come from what today is a medium-sized country, and so we're not quite in the position of the United States. But I think what has really changed from 10 years ago is that people sitting around the table understand that a problem in any of these big economies, including the one I'm from, will spill over to the rest of the world. And therefore, it isn't just a bilateral between the staff and the executive director for one of the big countries or for the United Kingdom or Germany or whoever. Actually, it's something where everybody has got a stake. And I haven't been an executive director of the IMF, but I have sat at the top table of the Financial Stability Board and elsewhere in the G20. And there is a much greater collective engagement than there was before this crisis. People have now realized that they really are in it together, and certainly not only my own approach, but the approach of many of my old colleagues from around the world was when you saw bad analysis that you thought could be endangering to your own country and others, well, then you went after the analysis, and I hope that will survive.
Thanks.
Okay, next question. The gentleman at the back, please. Yes.
My name is Henry Chen from SMU, a student. This is follow-up question on your shadow bankings. Because we understand now in the United States, even in China, shadow banking size is bigger than regular bankings. And in the new reform, it seems that all the emphasis on regular banking. Now, if you remember what happened last June is that it is just the fund redemption that caused the collapse of the emerging market currency last June. And then we found out that these financial efficiency vehicles, now if you remember last week, there's a newspaper report, we have abnormal growth of fund size because of the deficits. And most of these bonds were bought by the bond funds. So at the moment, if there's any redemption pressures, you are going to have a contagion effect that is going to run so fast. And then because of these mark-to-market rules, they will cause a very, very rapid contagion collapse of the system. So do you think that Chancellor Merkel's idea of really regulating this shadow banking is going to work it out? Because I also observed one thing is that in the 1980s, the Latin crisis, US Treasury can bail it out. In the 90s, of course, IMF can work it more or less alone. But in the last Euro crisis, even Greece IMF just cannot work it out himself. So it seems that the size of the financial system growth has made the capacity of individual central bank or even IMF very, very limited. So if there's no circuit breaker to break this kind of a very rapid contagion, unraveling of positions due to fund redemptions, if in case it ever happened, will the system become extremely dangerous? Thank you.
Well, I think, if I may say so, I think your question is extremely pertinent. Where I would reassure you is that most top policymakers have almost exactly the same concern that you have. I mean, the way that I put it is, as we re-regulate banks, so many of the risks in banks will just move into shadow banks and elsewhere. And senior policymakers are acutely aware of that. Since 2010, I think, 2011, there has been a major project involving people from the MAS here in Singapore on shadow banking. Europe is taking it very seriously. The European Commission has its own project within the global project on precisely that. I have some doubts, which I've expressed before, about whether the structure of agencies in the United States and whether the mission and powers of its new macroprudential body, the Financial Stability Oversight Council, will prove sufficiently flexible and nimble. And this is the dilemma. In this, I should bring out the dilemma I was talking about earlier. That I've said directly or indirectly a number of times this evening, if we write a static rule book, we're doomed, because finance will find its way around it. So why is it that legislators like rule books? Why do they like agencies to write rule books? And essentially it's because they don't want Congress or parliaments or whatever to give unelected officials unconstrained discretions. There is a very big point here. And I think one of the biggest dilemmas in financial regulation, which comes to a head with shadow banking, is how do we solve the political economy dilemma? That if we have regulators write static rule books, we meet the political concern, but in a way that is doomed to failure substantively. If we give regulators a lot of discretion, and the regulators in the UK have somewhat more discretion in the United States, then there is always a political concern that unelected officials have been given too much power. I think for 2 decades, at least, that's been true, and it perhaps didn't matter hugely. Now, for the reasons that you say, it matters hugely. That finding a way through that dilemma will be one of the 2 or 3 things that determines the safety of the international financial system over the next generation.
And just a quick follow-up question to that about the balance between the regulator and the regulated. I thought one problem that led to the crisis in the United States is that some of the large financial institutions, like AIG, could choose a regulator which was a little small office in Delaware, and said, you, the small office in Delaware, you regulate me.
Yeah.
And this is a multi-billion-dollar institution, and the mismatch in power between the regulator and the regulated was enormous. So how do you solve that problem?
Well, and it's in the United States, they probably have solved the problem of size and power by pretty well abolishing all of the small regulators.
They're all gone now?
Well, the particular regulator, the Office of Thrift Supervision, has gone. And there has been some consolidation in the United States. What remains a problem, not just in the United States but elsewhere, is when banking type risks turn up in capital markets, have the regulators in capital markets got the right mindset to deal with those problems? You cure this in Singapore by giving all the responsibilities to the monetary authority. So I would say that you are probably the furthest advanced.
Are they after the job?
No, but it's in other countries. No one's going to give the Federal Reserve power over the capital markets. No one's going to give the Bank of England power over the capital markets. It would just make those central banks too powerful. So the big challenge, and this is the core of my answer to you, is so you need securities regulators who are alive to these risks. They're certainly capable of it professionally. What it needs is for parliaments and Congress to ensure that they take that part of their mission as seriously as the other part of their mission, the vital question of honesty and integrity, which we've seen is also a grade one issue.
Well, I think on that note, I'm sure you'll all agree that despite the very technical slides that we were shown, we had a wonderful lecture that gave us brilliant new insights into what's happening in this field, and we really appreciate the time you've taken to spend with us today.
Well,
thank you very much.
Thank you, Kishore. Thank you. Thank you very much.